Hello, everyone, and welcome to the O'Hare Wealth Management Weekly Update for July 30th, 2025. I'm Jerry Jones, joined by John O'Hare, and we're going to walk you through a couple of questions that we've received from our clients of a financial nature, which we always encourage you to submit as well. You can do so by sending them to service@o'harewealth.com or texting or calling us at 414-644-0060. With that, we're going to jump right in. We have two questions for you this week. The first one is a two-parter, and John's going to address those at the same time. Was the second quarter GDP in line with expectations? And is a U.S. recession this year still possible? John?
Great questions, and I know the recession was on everybody's mind a few months ago and a big concern. Yes, we did get the GDP number on Wednesday, and it was 3.0%. The expectation was for 2.1%. So it was certainly a big surprise on the upside. And I think when we look at the long-term trends, in fact, I think we have a chart on long-term trends of GDP. Yes, we do. If you look at the long-term trends, and this chart shows that the blue dotted line is our trend growth for the US is 2.1%. So 3% is above trend, and quite frankly, a very nice number. If we could do 3% for a full year or several years, that would be fantastic. But we're happy with that number. I think everybody else is very happy with that number. And inside the data, it looked like there wasn't a lot of price pressure either, but that'll be a different number we're going to look at soon. So with that, I would say, and again, part of the concern about a recession came from the first quarter GDP that was negative. And it was negative because of what we refer to as front-loading product. We bought a lot of product from overseas and got it in here before the tariffs took effect. And when you bring in a lot of imports, it's a negative for GDP. And it was a huge negative for the first quarter. This, I think, is a big sigh of relief to see we still had strong growth in the second quarter. With that, I will say that I think the recession is definitely off the table here. We're just not going to see it. And a couple of factors here. One is the consumer is a big part of the story here. In fact, on the next chart, we're going to talk about how big the consumer is. Consumption is 70% of GDP, and the consumer is still strong. The job, actually, initial job claims have been going down for 8 or 10 weeks in a row. The JOLTS report was fine. Overall, we're not seeing a lot of pressure on employment, and that's positive for spending. I will say, however, parts of the economy, and quite frankly, housing, if you look at the top there, housing is 4% of our economy. Housing is in a recession. And house pending sales are down. They were reported on Wednesday as well. And you've got weakness in some of the publicly traded companies that make things like washing machines or parts and materials for construction. They're seeing weaker trends because of the housing. But again, housing's 4% of GDP. It's not going to knock us off a cliff. If you're in housing, you're not feeling real good right now. But again, I'm not worried about that dragging the whole economy down. One of the reasons I'm not worried, and we had a very good article in the Wall Street Journal, I think it was on Wednesday, talking about consumer credit. And we're going to have another chart talking about that, because if the consumer drives the economy, you want to say, what kind of shape is he or she in? And the Wall Street did a really good analysis of credit card spending, basically look at the low end, the middle, and the high end. And what was surprising is how strong it is on all three levels, and there's still capacity to increase spending. In fact, the article noted that the household debt service ratio currently is 11%. And when you look at this chart on the top here, 11.3 is where we were recently. If we're still 11%, it's near record lows over the last 40 years. that means the average consumer has room to take on more debt. Now, on the bottom, when you see delinquencies have picked up since the COVID stimulus we had and the sending paychecks out to everybody, but it's really about back where it was before or pre-COVID. So the debt ratio, if it was 12 or 13%, we'd be concerned about the consumer running out of steam. It's not. So no, we don't see a recession this year. The GDP number was very good. The scare from the tariffs, again, a lot of people forget our economy is mostly internal in the U.S. About 11% of GDP is related to imports from abroad. The tariffs are going to cause a few things to cost more, but as we expected, it's not driving us into a hole. So we feel pretty good.
Awesome. That takes us to our next question, John. Why hasn't the Federal Reserve lowered interest rates yet? This is a lot to unpack, but I'll let you dive in with that one.
Well, the interest rate question, I think everybody's been impatiently waiting for the Federal Reserve to lower rates because they've talked about lowering rates again. And one of the things they pointed out is they were going to try and get a handle on what the tariffs were doing to inflation. And if you go back to 2022, the Fed sort of got it wrong, and everyone pointed a finger at them and said, you guys weren't fast enough in raising rates to bring inflation down. Remember, inflation got up to 9.6%.
Yes, it did.
It's down to 2.8% now. It has come down quite nicely. It continues to come down, but the tariffs sort of put a pause in what the Fed thought they could do because they want to see how that plays out. Good news for them is a 3% GDP number certainly doesn't make it necessary to lower rates to boost the economy. We're already growing it above trend. So you can't argue with the Fed and say, hey, if we'd come in at 1% or 0.5%, there would be a very strong argument that they're behind the curve a little bit and they need to lower rates. At 3%, no, they can easily wait another quarter or two. And for them, they're going to feel pretty good about that. And my guess is they're going to say, hey, let's look at the second half and see how the tariffs work out. And remember, at 3% growth, these rates are not hurting us that much. Again, except for housing. If you're in housing, this really hurts right now. But for everyone else, it's not making a big difference. So don't expect any cuts, or at least we don't expect any cuts probably now till year end. Might be November or December. And again, we don't need them. And then by December, you're going to know what the tariff impact is. Much better feel for it. But they're going to do a wait and see, and they will react to data. If something changes here or seems to slip or you seem to get a spike in unemployment, they could change their mind very quickly. But right now, no, they're not going to lower interest rates soon. Let's focus on the fourth quarter for that.
Sounds good. That brings us to our book recommendation for the month, Breaking the Age Code. There is a video online that walks through the book in depth, but any anecdotes from you, Jen?
Yeah, I read this recently. I picked this up. I think I got it out of the Wall Street. Nice book, really easy read. Obviously, for people my age, Breaking the Age Code sounded like a good idea.
I'm not that far behind.
Yeah. So, and one of the big points of the book is they did a good job of laying out how you think about aging impacts how well you live and how long you live. The book claims that if you're positive about aging, you could add 7 years to your life. And for example, studies show that giving up smoking sometimes only adds 3 or 4 years. Mm-hmm. So that attitude is a big deal. And this author makes a very good case for it. And also reminds us that there's a lot of bias about older people or aged people and thinking, they all have dementia, they're all not going to be able to learn new things or new technologies. And she does a good job of disproving that, saying that's not an issue. No, it's a fun read. You'll enjoy this book.
As they said a long time ago, attitude determines altitude. I'm sure you remember that one.
You're right. That's a good point.
It's about how you approach the day. That brings us to the end. We want to thank everyone for joining us today. We really enjoy doing these. If you have any feedback for us on the content that we present in these videos or something that you think might be missing, please don't hesitate to reach out. On behalf of John, myself, and the rest of the O'Hare Wealth Management team, have a great day.
Yes, have a great week and enjoy what is left of the summer. It'll be going quick. Thanks, Jerry. Great job.